Hey everyone, welcome back to Corporate Decoder, the place where we peel back the curtain on corporate filings. This time around, Charles Schwab is dropping its quarterly report, and let's just say there is more than just stock market talk in here. Get ready for some serious deep dives into their finances and a few surprises that might just change how you see your favorite brokerage. Before we dive in, if you love getting the real story behind these dense financial reports, make sure you hit that subscribe button. We break down what matters so you don't have to. And hey, we've got a fantastic community brewing on Discord discussing these filings daily. Link in the description below. Scroll the Charles Schwab Corporation Management's discussion and analysis of financial condition and results of operations. So scroll. Alright, let's get straight into what Schwab been up to. This report is for the quarter ending the 30th of September 2025 and it's packed with numbers. Scroll 3 months ended the 30th of September. Scroll first, let's look at the key performance indicators. Net new client assets in the third quarter of 2025 shot up to $134.4 billion, a massive 48% jump from the previous year. That is a lot of new money flowing into Schwab. Client assets, a big number to watch, reached $11.6 trillion by the end of the quarter, growing a solid 17% year over year. And new brokerage accounts opened. They hit over 1 million, up 18% from last year. People are definitely still trusting Schwab with their money. Now for the big picture financials, total net revenues for the third quarter of 2025 jumped 27% to a cool $6.1 billion. That is a significant leap. Look a bit closer at the details and you see net interest revenue was a huge driver, up 37% thanks to lower borrowing costs and more lending. This is a big win, showing they're managing their funding costs well, while still growing their loan book. Let's dig into that net interest revenue. For the third quarter, it hit $3.1 billion, a 37% increase. What does that mean in plain English? Schwab is making a lot more money from the difference between what they earn on their investments and loans and what they pay out on deposits and borrowing. Management points to lower interest expenses because they've been paying down more expensive short-term borrowings, which is smart. Plus, their bank and margin lending are growing. Even though market interest rates are a bit lower now, the sheer volume and better funding costs are making this a very profitable area for them. Moving on to asset management and administration fees, they saw a 13% increase to $1.7 billion. This is driven by more money in their own money market funds and ETFs, likely benefiting from those higher interest rates we just talked about. It is good to see their investment products are attracting assets, which means steadier, fee-based income. Trading revenue also saw a healthy boost, up 25% to nearly $1 billion. This indicates that even with market volatility, clients are actively trading, and Schwab is benefiting from commission and order flow revenue. While client trading activity can fluctuate, this shows a strong uptick in engagement. Now, expenses. Total expenses excluding interest went up 4% to $3.1 billion. That might seem like a lot, but when you look at the revenue growth, it is actually quite manageable. They emphasize investments in growth and efficiency. Compensation and benefits did rise, which is typical with a growing company. But other costs like regulatory fees and assessments are down significantly, which is a relief. All this growth in revenue and controlled expenses led to a huge jump in income before taxes on income. It soared 64% to $3 billion. This is where you really see the impact of their strategy. And that translated to a net income of $2.4 billion, a massive 67% increase year over year. Their earnings per S-share, a key metric for investors, also skyrocketed. Diluted earnings per common share reached $1.26, up a staggering 77% from $0.71 last year. This clearly shows the company is becoming much more profitable. Scroll Investor Services, Advisor Services. Scroll looking at their business segments. Investor Services raked in $4.9 billion in net revenues, a 27% increase, while Advisor Services brought in $1.3 billion, up 25%. Both sides of the business are firing on all cylinders. Thanks to that growing client base and increased market activity, they're effectively serving both individual investors and the advisors who manage money for others. Now, let's talk about risks. It is not all sunshine and rainbows. Schwab faces market risk, which is basically the danger of losing money due to changes in interest rates, equity prices, or market conditions. They use fancy tools like interest rate swaps to manage this, especially with their large investment portfolios and loans. They simulate what could happen to their net interest revenue if rates change. The crucial takeaway here is that their simulated net interest revenue was less affected by interest rate hikes or drops as of September 2025 compared to the end of 2024. This suggests they're getting better at protecting their earnings from interest rate swings, partly due to new hedging strategies and lower cash balances. Liquidity risk is super important too. It is about Schwab's ability to have enough cash on hand to meet its obligations. They generate a lot of cash from client activity, but also rely on external funding like borrowings from the Federal Home Loan Bank and repurchase agreements. The good news is, despite using these external sources, they've been significantly paying down their more expensive short-term borrowings, which is a very positive sign for their financial health. Scroll average for the 3 months ended the 30th of September 2025. Scroll, they also report their liquidity coverage ratio, or LCR. This is a required measure to ensure they have enough high quality liquid assets to cover potential cash outflows during a stressful 30-day period. Their LCR was 134% as of September 2025, meaning they have more than enough liquid assets to cover outflows. That is well above the required 100% and shows they are well prepared for unexpected events. Capital management is where they focus on having enough money to run the business, support their subsidiaries, and return excess cash to shareholders. They're considered well capitalized by regulators, which is a big deal. Scroll the 30th of September 2025 CSC scroll looking at their capital ratios. Schwab's Tier 1 leverage ratio was 9.7% at September 2025, which is strong. As for their banking subsidiary, CSB, its Tier 1 leverage ratio was even higher at 12.4%. These ratios are well above regulatory minimums, indicating a very safe and stable financial position. They've also been busy returning capital to shareholders through dividends and significant share repurchases. And what is next? In a major move announced on the 6th of November, Schwab is acquiring a company called Forge Global Holdings, Inc. This is a private market platform, and Schwab sees it as a way to better serve investors looking for alternative investments. This acquisition, valued at around $660 million, is expected to close in the first half of 2026. It signals Schwab's ambition to expand beyond traditional investing services. Now, for my take on all this, Schwab is showing incredible financial strength. Those double-digit revenue increases, massive profit growth, and soaring earnings per S-share are not just good numbers. They're a testament to their effective strategy. They've successfully navigated higher interest rates by managing their funding costs and growing their lending businesses. The reduction in expensive short-term borrowings is particularly impressive, demonstrating strong financial discipline, while market risks always exist. Their robust liquidity position and solid capital ratios suggest they are well equipped to handle economic uncertainties. The acquisition of Forge also shows a forward-thinking approach aiming to capture new growth areas in private markets. In short, Schwab is firing on all cylinders. Their core business is thriving. They're managing their risks effectively, and they're making strategic moves to position themselves for future growth. Investors should be very pleased with these results. Alright, that is our breakdown of Schwab's latest filing. What do you think of their acquisition plans and their impressive financial turnaround? Let us know your thoughts in the comments below. If this deep dive helped you understand Schwab better, please smash that like button, it really helps us out. And of course, subscribe for more corporate breakdowns. Don't forget to join our Discord community, the link is in the description. Thanks for watching, and we'll see you on the next episode of Corporate Decoder.